You are listening to KeyStone's Stock Talk Show, episode 270. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to chat with you again. I will start this week with a look at Moats and how they apply to investing and if they are a good data point to use when investing specifically in small cap stocks. In our Your Stock Our Take segment, Aaron revisits a viewer question on Exro Technologies Inc., symbol EXRO on the TSX, a clean technology company that has developed new generation power control electronics. When he last reviewed this small cap, Aaron recommended avoiding the company, and we presented another profitable electrical related stock, Hammond Power, as a better alternative. We will let you know how both performed over the same period. Brennan reviews a small segment from our recent live webinar on how to find the next 10x stock, answering the question when one should take profits on a stock. Finally, Brett takes a viewer question on Ballard Power Systems, BLDP, on the TSX, a developer and manufacturer of proton exchange membrane or PEM fuel cells, a type of hydrogen fuel cell. For decades, Ballard has held promising technology, but the lack of profitability has produced dismal long-term returns for shareholders. Brett lets you know the company's current financial picture. All right, let's get to the show. My co-host, Mr. Aaron Dunn, and both of the Killer Bees are back with us today. How are you guys doing? How's your vacation, Brennan?
I mean, it wasn't much of a vacation.
Gone? I didn't know.
Yeah, just for a wedding over the weekend. And I mean, it was a lot of fun. Yeah.
It wasn't a relaxing vacation, likely, right?
No, Monday I was very tired, as these guys knew. I should have almost taken it off, but there's too much work to do. So, yeah, can't. Responsibilities.
For sure. Well,
more work got done when Brennan was away on vacation, but we won't get into that now.
We finished those 10X webinars last week. You can get those on demand on our website. We'll likely put out with this podcast, the email that comes out in this podcast, an option to, if you haven't yet seen those 10X webinars, you can purchase the on-demand version that was just completed. So, okay, let's get to our poll question, and then we can do a meme that Brennan really wants to get to, right?
Yes.
He's chomping at the bit. Champing, yeah. I think it is. So the poll question, Brett, I'm going to let you take it. You might as well.
Yeah, so the poll question we had this last week was, if you receive a large sum of money, how would you invest it? So this is a relatively common question because people might have inheritance, even lottery winning, something like that, where they just suddenly, not their routine income level, they just as a nice sum of money that comes along their way. So really, how would you invest it? 27% said as soon as possible, so right away. 51% said over time, so dollar cost averaging. 22% said wait for a decline in the market before investing. And I actually looked up quite a few different things on this. And specifically, if you are looking just for on average, like if you just happen to receive that money on any random day, not a specific time period, on average, as soon as possible is the best. It's that adage of time in the market will perform better than trying to time the market, which is waiting for the decline. Obviously, if you could perfectly time the bottoms, you would do better, but the reality is you're human. You're not perfect. We aren't. Besides Aaron, he's a robot and he's very perfect, but but no. And then the other thing, which I'd really always mention, is just because dollar cost averaging is statistically, and it's only ever so slightly statistically worse, and it depends on what time period and so on. And if you were to take a declining market, it actually performs better, and that's why people like dollar cost averaging. It's actually more of a behavioral thing. So if you feel more comfortable over a year or something to invest money, it's not going to really move the difference, but a lot of people find that behaviorally more satisfying. It doesn't freak out if, there's a drop, a 5% drop the next day. or something like that, or a COVID drop where it's down 20-30% in a month, that dollar cost averaging does help you there, and that helps a lot of retail investors in general.
Totally.
Yeah, and I mean, I think it depends as well on, what your intentions are with investing that money. So if you're talking about building a portfolio of individual stocks, maybe you want to get up to 20 to 25 companies, depending on how much capital you've come into. You're not necessarily going to have all of those companies at hand you want to invest in, because usually when you're investing in individual stocks, you're looking for undervalued or somehow extraordinary opportunities that are going to outperform the market. And those don't come along every day. You can't just point at the market at any given time and pick 25 stocks on day one. But if you're looking to take a more passive approach to investing, like just get a good, consistent market average return, not have to put in much work, then I wouldn't see any reason why not to just, put that money in an indexed ETF right away and just essentially let it run. But one thing I will say is even if you're deciding to take a patient approach and not invest all the money right away, is, given the current interest rate environment, you would still want to put some of that either in a GIC or a high interest savings account. Make sure you're earning something off of it, because with rates where they are, you can actually earn a decent, I think probably around 4%, for a year. GIC is around what the rate is right now. So.
Yeah, I think even just, looking at my own investing career and, back in 2021, I almost got FOMO myself where, that's especially when my portfolio started off really small, adding about $1,000 a month to it. And, every single time I would add capital to my portfolio, it was like it was just burning a hole in my pocket and I needed to deploy it that day. Where again, there was opportunities, but I found a lot of the time, maybe take a half position. I'm sure podcast listeners, our clients are, familiar with this, but I found, easing into positions can definitely be of benefit. Obviously it depends on, the investment or the stock that you're looking at. But that's definitely something that I've learned over the years is, just because you put $1,000, into your portfolio that day or into your account doesn't mean that you need to invest it that day. So I'm definitely taking more of a slow, methodical approach over the last few years, at least.
Yeah, and it kind of differentiates our strategy from the average advisor in Canada. When you typically go in, they're gonna, put your information into that computer, spit out a mix of mutual funds, ETFs to buy right away. There are some advisors that do it better, but the vast majority of Canadian portfolios are built that way. And we do even see that with some of our clients who start off and they get on day one, get too excited, want to add a ton of companies and then not look at it for the rest of the year. We're not asking you to look at it on a day-to-day basis, even week to week. It's not even every month, but if periodically through the year on a quarterly basis, if you start with 3 to 5 stocks and then every quarter add 2 to 3 new stocks, it's not a lot of time at all, but it helps allay the risk of entering the market and at one entry point and having a correction right after that. You're going to build that portfolio over time. Often we can't give you 25 stocks to buy today, but if you give us 18 to 24 months, we can come up with 25 good companies and better entry points over that time as well. Okay. Yes. Brennan, you have a meme. Meme.
I do have a meme, and I will share my screen here
with the meme.
Okay. So, yeah, I thought it was pretty topical just because the debate was, just last week, I believe. And I thought that it would be kind of funny on the podcast. So I'll describe it for the listeners first, and then we can laugh at it together or make some comments. So there's two guys basically that are yelling at each other. Both of them, it shows their brains through their skulls, and they both have small brains. And they're yelling at each other. And the one guy above his head, it says Trump won the debate. And the other guy says, or above his head says, Kamala won the debate. And then there's a third guy with a really big brain that is calm, cool, and collected, not yelling at anybody. And he says, I'm going to hedge my portfolio so I make money regardless of who wins. So anyways, I don't know if you guys have any comments on it. I thought it was funny when I saw it.
It's a pretty funny meme. I guess my first thought was that the guy with the big brain maybe isn't as smart as he thinks because he doesn't know what hedging actually means.
Yeah,
when
I
you
mean,
hedge your
we're kind of finance nerds, and we look at the word hedge, and
Yeah.
that's not the way that it should be
yeah.
used.
So by
It's
hedging your
you can build
portfolio,
your
that doesn't
portfolio
mean
or
you're going to make
construct it. Yeah,
money
yeah,
regardless of what happens. That means you're going to reduce or eliminate your risk regardless of what happens. But by eliminating your risk, you also eliminate your return. So if you were to completely hedge your portfolio, you would have a portfolio that had essentially zero volatility, but it would also have zero return.
Yeah.
So whatever. I
Yeah,
still think he's
exactly.
smarter than the guy on the left, but whatever.
Yeah, definitely. And that's the thing. Like when I initially brought this to Brett, I was like, yeah, we should probably change it so it says build my portfolio rather than hedge. But yeah, anyways, we can move on. Thanks for
No,
laughing,
and
Ryan.
I would say even if you're looking at hedge, because some people will say they're hedging against whatever election outcome. Besides specific industries, so when a policy is like very hot topic for whatever presidential or Canadian prime minister or whatever political party in whatever country gets in, and normally they don't actually influence, especially in developed countries, Canada, US, Europe, don't really change the overall trajectory of the stock market past a few specific policy changes. And especially if you just look at it, there's not too many because you can only really go back to post World War II in the US, and there's only not even 20 elections, and even then you probably should go after post Brennan Woods, which is about a dozen elections since then. Most of the time it's not statistically significant who gets in for what correlation with the stock market returns over the next year after they get in. There's, I think, a slight bias towards Republicans the day after, specifically the day after the election. So if you want to hedge that out, sure.
Yeah.
But over time, it doesn't really make a difference on the broad markets, which, as much as people want to get angry
yeah.
about who's in power,
I'd agree.
that's
Yeah,
what occurs.
using factors like what party, political parties in power, even taxation as your primary determinant of making an investment are typically bad, just bad policy in your investment portfolio. Like you should use. Don't try to get too cute. Buy the best companies out there. They typically do the best, regardless of who is in power or what the taxation issue is. And we get this question all the time. People not seeing the forest through the trees, where you get the question on should I not buy as a Canadian a dividend paying stock in the U.S. Outside of my RSP, for example, and it's because of a withholding tax. It's 15% of a dividend. Well, if it's a great company, that is such a small percentage of your overall concern and return that you need to, you might not even be able to get access to that company in the Canadian markets with a Canadian stock. And we've seen that many times with Microsoft before as an excellent company. 5, 6, 7 years ago, we bought it. If you didn't buy that company or put it in your portfolio because you were worried about the 1.8, the 15% of the 1.8% on the dividend that you were going to pay on that, you could have bought it $98. It's 400 plus today. Those returns pale in comparison to the slight amount that you may have paid a little bit more in taxes. So focus on the things that really matter in your portfolio and don't get distracted by the noise. Is what I'm trying to say. All right, are we moving on?
Let's.
Good.
Yeah,
I'm
I
gonna.
mean, one thing that we
Yeah.
should also mention as well, just in
Oh,
terms
rate
of
cut.
the news,
Yes.
is that the U.S. Fed did cut rates, announced a 50 basis point rate cut. So this signals the end of their fight against inflation, essentially. And we would expect, we've seen 3 rate cuts in Canada. I think they've only been 25 basis points, have they? Or
I believe so,
so
in Canada.
75% or 75 basis points cumulative in Canada. The cuts are widely expected to continue probably into at least early next year. So that's that's a fairly significant turning point for the U.S. economy, the stock market, likely. That they're now starting to do that. One of the things that we have definitely noticed, I'd say over the past 4 to 6 months, is capital starting to flow back into some of the interest sensitive sectors. So that would include utilities, that would include REITs, a few others, lower growth income producing stocks, essentially. We actually just put out a report, a large report, comprehensive, on the Canadian REIT sector that covered every publicly traded REIT in Canada. provided some commentary, and then our list of recommendations. But we're definitely seeing capital start to flow back into those areas. Likely that continues as long as the trend towards lower interest rates remains.
Yeah, so there's definitely some opportunities and has been some opportunities in good quality dividend paying stocks that likely suffered as rates rose. Now you're seeing rates come down. They look more attractive relative to interest bearing securities. So we're moving to our Your Stock, Our Take segment. Aaron's going to look at Exro Technologies. I'll let you take that away, Aaron.
Okay, happy to do that. I'm going to do a Your Stock, Our Take. This is actually a recap on Exro. So Exro is a company that we have done 2 Your Stock, Our Takes on over the past year. I'm happy to revisit the company again. And we are titling this segment, Aaron Does Not Understand the Technology. Okay, so I will explain why it has that title in a moment. But Exro Technologies, they are an e-mobility technology company that is developing advanced power control, electronics, and propulsion systems for the electric vehicle industry, serving OEMs. The company trades under the symbol EXRO for a stock price of 29 cents, a market cap of $165 million, and it has almost 570 million common shares outstanding. So that is a lot of shares outstanding. This company has gone to the market several times to raise capital in order to fund its business. So we originally did a Your Stock, Our Take on the company about a year ago, a little over a year ago. I believe it was in June of 2023. We took a look at Exro. My basic conclusion was that the company was pre-revenue, wasn't generating even any revenue, was losing a lot of money. I made the case that the fact that there was no revenue or very little revenue and huge net losses, that Exro was speculative. But I did identify and I did admit that, there were a few things that looked interesting we could keep an eye on. And if the company started to produce actual revenue, then maybe we could further the research. But at that point in time, it was too speculative, and I advised people to stay away from it, at least as an actual investment, as opposed to just a speculation. So I thought that was a very balanced perspective on Exro. But not everybody agreed. And in fact, there was many comments on our YouTube channel basically saying that we did not understand the technology, that we didn't know what we were doing. Some people were very angry. Some people, they toned it down a little bit. So, this comment here, Chap said it best. I think that I am Chap, is what this person is saying. But Exro's technology is too complicated for these guys to understand. Therefore, they do not comprehend the revenue potential. I mean, that's fine. Fair enough. I admitted we did not understand the technology because it is not possible to understand deeply, at least to the threshold that I would consider true understanding, all of the different technologies in the world that are present in the public markets or that companies are pursuing, especially emerging technologies. But some were, a little more extreme, like this one. Your analysis is worth what I paid for it, 0, which I thought was a little sharp, but whatever, to each their own. If you want to take that perspective, go ahead. So essentially, what happened over the 7 months or 7 or so months after that, was the stock price of Exro declined about 72%. So when we originally profiled it, 222, and then back in April, down to 63 cents, right? So I think that was actually about 10 months or so after. Now, we thought at that point, given that the share price had come down so much, we would take another look at it. So we did another Your Stock, Our Take, reviewing the financials. At that point in time, there was some indication that maybe we would see some progress in the financial performance, but we didn't. And we continue to say, we think that this is a speculative company. It's not producing any significant amount of revenue yet, and it's burning a lot of cash flow. And so that makes it high risk, but, we'll continue to follow it. And we do hope that the company is successful. And once again, that really turned out to be the right move, because since then, the stock has declined another 54%, now down to 29 cents. But, Again, not everybody agreed with our perspective, even after an 87% decline from the original profile on Your Stock, Our Take. And again, we got a lot of angry comments from people that thought we should have had a better perspective of the company, such as this one. I want my 15 minutes back. Pretty worthless analysis. You should really dig in to the fundamentals and not look only at financials. Basically, it's a company that will generate billions of dollars per year in revenue in 3 to 5 years, and their patent portfolio alone is worth a couple of $1 billion. So, again, one of the things I always talk about when I'm looking at these high technology companies is the technology is incredibly complicated. So yes, I don't pretend to be an expert, but most of the people that believe that they understand the technology or the commercial potential, they shouldn't consider themselves experts either. So I'm going to take a look at this comment and just from a educational perspective, look at some of the assumptions that are being made here, because I think that every time investors look at companies, or it's common, there are assumptions that are being made when you're making an investment. And it's always important to review those assumptions. So here's an assumption. The company will generate billions of dollars a year in revenue in the next 3 to 5 years. That's a pretty strong statement. The company, as of their last quarter, I think generated about 5 million in revenue. So billions of dollars a year in revenue is a pretty extreme acceleration in revenue growth. Not many companies are able to make that transition. So just assuming that that is going to be the case, and not factoring in the risk that something will derail that growth, is a pretty poor assumption to make, and not what we consider intelligent investing practice. And the other assumption here, their patents portfolio alone is worth a couple $1 billion. Well, how do you know that? Are you an expert at evaluating technology patents? Have you looked at all the patents and analyzed them? Have you spoken to people that would actually purchase the patents and got an assessment of what the market value is? I'm guessing probably not. And here's another question. If the patent portfolio alone is worth a couple of $1 billion and the entire market cap of this company is less than $200 million, why don't they take the company private? Certainly, they're not getting the recognition that they would deserve then in the public markets. So they could take the company private at a premium of 2 to 3 times the current share price, probably make some investors happy. And it would be an excellent value investment, but that's not happening. So always review your assumptions. But we're not going to beat down on this commenter, and I don't want to beat down on the company either. I want companies to be successful. But what I do is I look at what they're actually producing as opposed to what they're saying they're going to produce in the future, which are always the most optimistic projections that management can make. So the company just put out their Q2 financial results. Why don't we have a look at what this company is actually producing? So we're going to start off by looking at the income statement. Let's take a look at the revenue line. So the company is now generating meaningful revenue, 5.3 million in the quarter compared to no revenue in the previous year. So that's good. They are transitioning to revenue. They're actually selling something now. I like to see that. But there's something else I see here that I don't like, and that's negative gross profit. It actually costs them for every unit that they sell, they actually spend more money producing that unit. So this is like if you own a sandwich shop and you sell sandwiches for $1, but every sandwich, all of the supplies that go into making that sandwich, like the bread and the meat, cost you $1.50. Every time a customer walks through the door, you lose more and more and more money. And that doesn't even include your other overhead costs, like your rent, your utilities, whoever is managing the facility. So having a negative gross profit is a major problem. And even most companies that are losing money don't have negative gross profit. It's actually extremely rare to see a negative gross profit. So this is something that would be a major red flag, because revenue growth in this situation is not actually going to get the company out of the situation where they are losing a lot of money. In fact, if you have a negative gross profit, the more you grow revenue, the more cash you're going to burn. And then on the bottom line, net loss, $25 million. So now they're actually producing revenue, but their net loss actually doubled. It's another problem. $25 million in a single quarter. That's $100 million a year annually in net losses. And these are actual cash net losses too. So if we go to the cash flow statement, we can see operating cash flow used, cash burn, 26.2 million just for the quarter. So that's a major burn of cash flow just in the quarter. And how long are they going to be able to keep this up without raising more money? Well, we'll take a look at the balance sheet for that. 2 million in cash. They only have 2 million in cash on their balance sheet. So that's not going to last them for very long. And then if you look down at the debt, they have $75 million senior secured promissory note and another $12 million in convertible debentures. So they already have debt, about $87 million plus in debt. And they're losing 26 million per quarter. Now, this can change. They can turn the company around. They can start making money next, or they can increase revenue next quarter, get a better gross profit margin next quarter, maybe reduce the net loss, or even start making some money. But there's no indication that that's going to be the case at this point in time. So just assuming that that's going to be the case and putting your money behind that is taking a major risk. Now, if we look at the earnings release in terms of what the company is expecting, we can see they are expecting a path to profitability. So the initial target right now is 10 million US in profitability, and they say they're on track to that with that in 2024. Okay, so 10 million US, but they lost about 38 million in the first 6 months of the year. So in order to achieve 10 million in the entire year, they're going to have to make about 48 million. Now, $10 million also doesn't tell us what is this net earnings, is this adjusted EBITDA, what adjustments are basically being made here. But I would say they have a very long path to even getting to 10 million. And even if you get to that 10 million, how many more shares are going to have to be issued between now and then? Even if you get to those billions in revenue that some investors are hoping for, how many billions of shares are they going to have outstanding? And are they going to even be achieving profitability? So these are all the questions that we ask ourselves when we're looking at a company. And right now, we don't see any evidence that the company is on track to achieve their profitability guidance. So in terms of just intelligent investing principles, and this isn't about Exro or any company specifically, these are just intelligent investing principles. The profitable commercialization of a newer emerging technology is always going to be inherently high risk. And that means there's always going to be a very meaningful probability that it's not going to work out, no matter how confident you are in that technology. Successful commercialization should never just be assumed. It's always high risk. Now, revenue and profitability, what they do is they do provide tangible validation that the company's business model is economic and that the technology is actually marketable. Now, you can't be an expert in every technology out there. You can't be an expert in every industry of every company that is available in the stock market. But what revenue and profitability tell you is that the people in the industry that company is serving, that technology is serving, that actually are experts in that technology are willing to take money and actually pay for it. So that's validation of the business model. Now, we've looked at research. We've talked about it before to our clients and on the podcast. Revenue and earnings growth, they are the most important factors, statistically speaking, when you look at the historical data related to long-term stock price appreciation. Now, in the near term, stock prices go up and down. Some companies can do extraordinarily well without any financial foundation whatsoever. But that never lasts long-term. In terms of companies that produce long-term, consistent investor value and stock price appreciation, those companies are almost always companies that are profitable and growing the revenues and the earnings. And then finally, any company with no revenue or that has a substantial net loss, no matter what you think about their technology, no matter what the company is promising about the future potential, they're always high risk. They should always be seen as high risk. If you want to invest in them because you like the idea, go ahead and do it. But you also have to recognize the fact that you're making a speculative high risk investment. Now, we're going to check in on Exro again down the road. I don't want to beat up on this company. This is nothing that is personal against Exro. Would make me extremely happy if when I check in on Exro in a quarter or two, they show significant improvement in their financial performance and the company ends up doing well and becomes a major success story. I support businesses. I support entrepreneurs. I support a technology industry in Canada, which we desperately need, and great ideas. But in terms of actually evaluating an investment idea, there's a very specific criteria that you need to follow in order to do that. So we hope that companies like Exro are successful, but we're not just going to make that assumption, especially when it flies in the face of what we're seeing in the current financials. All right. So that is all I have to say.
Yeah, great job. Like, I think there's two things at play here, and like we even kind of went over this in the recent webinar a little bit as well. Is with those commenters, number one, overconfidence bias. Just like these commenters are showing the tendency to overestimate their abilities, like you said, patent valuation, essentially, showing that or believing that they can't and won't be wrong. It's bound to have billions of revenue. And I've said it before on the podcast, and I love this Mark Twain quote, but again, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And even in that webinar, I actually used Exro as an example, because, again, it's kind of the confirmation bias that is also at play here. Where the confirmation bias is people's tendency to process information by looking for only information that is consistent with their existing beliefs. And there was this individual on a billboard that essentially right after Exro posted horrible numbers there that Aaron just went over, this person, and the stock was down, I think, like 30 or 50% in the day or something significant. They noted the product that looked good before hasn't changed. The management team that looked good before hasn't changed. Revenue up, losses are down. UL certification is done. My expectation is profitability by the year end. But and they say no idea why a startup still not making a profit turned on panic mode. Well, Aaron just went over the reasons why panic mode happened. Mounting debt. Losses were up significantly. Cash flow, losing 26 million in the quarter. The share count is, gross now. Like, are you going to go to the market again and issue shares at, 26 cents?
They did.
Well,
they just did.
I'm sorry. I don't want to rag on it too much, but I need to stop there. But anyways, I think you did an excellent job, Aaron.
And I can say on the flip side, following Aaron's segment, we said if, because Exro is a way to participate potentially. This is what investors are looking at in electrification. And we said, rather than invest in a company like Exro, we said, why not look at Hammond Power? And if you can see my screen right now, at that time, Hammond Power was trading around the $46 range.
Yeah.
And today we see it at 134.54. That's up 190 plus % over that same period. And why has Hammond Power gone up? Well, it's the exact opposite of what Exro has been doing. You see here, growth in sales, growth in net earnings. I mean, net earnings were up like 76% in the last quarter. That is driving this company to new highs. And that is why the financials, the fundamentals of this business matter. And if you talk about a company looking to power its way to $1 billion in revenues, as we can see here in December, the year end December 2024, there's 247 million in revenues. Trailing 12 months is 750 plus. By the end of this decade, they have the target of getting to $1 billion in revenues. They're well on their way to doing it far ahead of that time. And that's what we're looking for in businesses. That is what drives your 190% gain versus your, what was Exro down? 80%? Yeah, 87%. So that is the juxtaposition. And we've shown this a number of times on the podcast, looking at two businesses. One, both businesses that you can potentially play on a theme like electrification. One, profitable, great balance sheet, growing, a track record of doing that. The other one, with a hope and a dream in that sector, really no underlying fundamentals that would meet our criteria. Again, we wish Exro the best, but we're looking at the numbers, the growth, the history behind the business, and that is how you get a gain of 190% versus a loss of 87%. It's not just us saying this in retrospect, it's what went on the podcast. We talked about investing in Hammond Power, not investing in Exro. Proof is in the pudding. We were told we were idiots at the time, but we like to look back and show, following the numbers, following the growth, that is what you do to invest long term, particularly if you're looking at smaller cap stocks. These are riskier investments, generally speaking. Make sure they're backed by profitability and they have growth there. And then you can get the gains you're actually looking for, not just a hope of a sales at some point in the future. Okay, hopefully that makes sense.
The technology,
and I should just add me saying that they issued shares, they closed on a 25 million share placement, and they were actually looking for 30 million. So even at the current price, that normally implies they're having troubles placing it, which is a concern, because when you're looking at that, if institutional or larger investors aren't looking to buy that price, that's also concerning, because that means that the funding or the ability to fund is starting to come down. So that's a concern just on a capital raising standpoint.
For sure.
25 million, and how long does that last them? 1 quarter, right? Potentially.
Yeah. I looked at it, the FFO for the last quarter. So like the first quarter, they've really had revenue. It came out to like 21 million. So that's before all the working capital they had. Like their net income looks a bit nicer in this last quarter as well, just because they had some gains on the debt and a bunch of other moving parts. But you're looking at probably 20 million a quarter right now losing in cash.
Mm-hmm.
All right, so I'm going to move to my segment. One of the core areas of our research is profitable growing small cap stocks. We just completed a webinar on how and where to find 10x stocks, or essentially great long-term growth stocks. The data tells you that profitable microcap stocks are fertile ground for identifying potential 10x stocks. In the webinar, we included 10 traits we look for in a potential 10x stock. One question we get seemingly more and more often these days surrounds the idea or ideal of a moat, which is one thing we look for but cannot always define with confidence, particularly in the small cap arena. So today I thought I would give you a brief definition of what moats are in terms of investing and if they apply to identifying great long-term small cap stocks. Now, this segment came from our overall 10x webinar. The segment that it came from was how to identify the profile of a great 10x stock. It was one of the 10 traits that we used. So I'm going to first define what is a moat or a key advantage. In finance, we kind of love using both sports and military related terms to describe what we think are like economic terms. So the analogy relates to moats that would surround medieval castles and act as barriers of protection. Put differently, an economic moat describes an advantage that is difficult to copy or emulate, giving a business the ability to maintain a competitive edge over its competitors. Now, the term was made popular by Warren Buffett, who described how seeking such a business is fundamental tenet of his investment strategy. Let's look at that direct quote from Buffett. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. The product or services that have wide, sustainable moats around them are the ones that deliver rewards to investors, from Warren Buffett. Of course, not everyone believes economic moats are the bee's knees for a company or in the investing world. Enter Elon Musk, for example. He so eloquently stated, and I quote, "I think moats are lame. If your only defense against invading armies is a moat, you will not last long. What matters is the pace of innovation. That is the fundamental determinant of competitiveness." Now, here I would say both have points, but I think also that they're both not mutually exclusive. I would not think for 1 minute that Buffett believes that once a company achieves some sort of economic moat, hard or soft, they can just rest on that said moat and forever milk the profits. He believes in innovation. In investing, nothing is a straight line. Arguments are not black and white, and goalposts are always changing. I believe Buffett understands that to sustain a moat, innovation is critical. Therefore, you cannot you can want to find businesses to invest in with moats and also require them to innovate to sustain that moat. But for Musk, a nuanced argument, while likely more correct, does not make for a good quip or tweet, such as moats are lame. So let's look at the 5 basic economic moats. The first would be the network effect. The network effect is defined, it's really present and found when the value of a product or service grows as its user base expands. Each additional customer increases the product or service's value exponentially. An example of this, the more customers who use, say, the Visa V card, credit card, the more attractive that the payment network becomes for merchants, which in turn makes it more attractive for consumers, and so on and so on. It builds on itself. So let's look at intangible assets. Though not always easy to quantify, intangible assets may include brand recognition, patents, and regulatory licenses. They may prevent competitors from duplicating products or allow a company to charge a premium in terms of pricing. Walt Disney is a good example of a company that's built a moat based on the intangible asset of brand. In fact, strong brands support robust and sustainable economic profits at both of Walt Disney's or all of Walt Disney's real key businesses. Starbucks is another good example of that. In terms of patents, many drug companies with long-term protected patents offer exclusivity and are a good example of this type of moat over time. Let's look now at cost advantage. That would be point number 3 here. Companies are able to produce products or service at lower cost than competitors, are often able to sell at the same price as the competition and gather excess profit, have the option to undercut competition. Now, if you can make it for less, you can sell it for less. This can apply to manufacturing or other industries. Buffett, when thinking of low-cost production moats, uses Geico, Berkshire Hathaway acquisition, a long-time company in his portfolio. As an example, Geico is considered a low-cost insurance provider. It has been essential for the company's competitive advantage. Number 4 in our 5 basic economic moats is switching costs. Switching costs give a company pricing power by locking customers into a unique ecosystem. Beyond the expense of moving, they can also be measured by the effort, time, and psychological toll of switching to a competitor. Consider Intuit, which offers its customers various bookkeeping software solutions. Because learning to use Intuit's applications takes significant time, effort, and training costs, few users are willing to switch away from the company. Similarly, if not better examples are Adobe and Autodesk. Autodesk's AutoCAD computer-aided software application for 2D and 3D design and drafting. It's very hard to change this over in a company once your entire staff has been on that program for years. Finally, if we look at efficiency scale, this moat applies in a market limited in size. Potential new competitors have little incentive or to enter because doing so would lower the industry's returns below the cost of capital. Moats built on efficiency scale apply to a small number of businesses like a large, say, freight operator. They also apply to companies that enjoy kind of monopolies like a public utility, an electricity service company. Now, there are also soft moats. Some of the reasons a company might have an economic moat are difficult to identify. These would be in the soft category. Moats are created by exceptional management or a unique corporate culture. While difficult to describe, a unique leadership and corporate environment may partially contribute to a corporation's prolonged economic moat. Just commentating generally here, in terms of small caps, we find true economic moats at the, say, micro cap level. It's more difficult to define with certainty as the businesses are by definition starting very small. Other than potentially holding intangible assets such as a patent, it can be far more difficult to define a true moat at a small level. A moat initially at this level is often based on opinion. If you're trying to invest based on a moat as a criteria more than data. Moats are therefore as singular thesis for investing in small caps, often fraught with peril. Yes, Microsoft, for example, has a definable moat, but it's the largest company in the world. Today, Boyd due to its size, can be said to have somewhat of an economic moat that allows it to have greater purchasing power and reduce costs with over 950 plus locations. But one could not say that when we originally recommended it, and it had around 37 locations. It could only be at that point a prediction or a guess with a high degree of risk. What I'm saying is Boyd did not have an easily definable moat, if any, when we originally recommended it. So a moat is great to have, but harder to define with any degree of certainty in most cases with smaller companies.
Yeah, I mean, I think it's good. I'm glad that you covered it because it's a question that we get all the time. We'll come out with a new recommendation. Well, what is this small caps moat or whatever? And again, sometimes you don't have a moat. Sometimes you can, even just be a small fish in a big pond. I mean, maybe it's not a perfect example, but like even like the music industry, for example, you can have a really, really good music career and not have specific moat or differentiation between all the other country artists or rappers or whatever. Again, um to be a successful business, you don't necessarily have to have a definable moat like Ryan was saying. And again, Boyd is a great example of that.
Yeah.
And just on like the size component when we're talking about moat, people always like to, the one which I always heard in university, because numerous courses would of course talk about moat, is Apple time and time again, because they have their own ecosystem effectively creating that isolated. So if you think about like a actual castle moat, they would have like a nice big wide moat. It'd be difficult to get over for invaders to get over. But then if you think about a small cap, they'd have a small little castle and likely a small little moat. Might be a little trickle of a stream around it, which anyone can just walk over. You can get in the castle easily. And it wouldn't make sense for a small cap, a small castle, to have a big moat. It just doesn't really make sense. Even in an analogy, it wouldn't make sense. It's adding more like investment into something they don't really need. They don't need that technology. And then if you further look at many of the small caps that we'll look at, it's a fragmented business. Why is it fragmented? Because you need to be in a certain geography. And if other people try to come and compete, a bigger company tries to compete, it just doesn't work within that geographic region over and over again. So they may not have a direct technology mode. It plays in a bit into like the efficient scale.
Yeah.
But at that point, it really just plays into the small cap favor, and it's not really a distinct mode. You could maybe call it a soft mode, something like that, but it's not a defined mode like what people think of with technology. It always comes back to the technology mode almost when people are bringing it up, and you don't really need that technology mode.
Yeah, you could have that moat on a smaller scale in the efficiency area if they geographically were. And we, there's a company, Dynacore, that may be considered in the region that it is to have that type of moat. There's other reasons you might say that it doesn't have a moat too. So, and you can argue both sides of that point. Is it a key determinant in a smaller company? It would be great to have. Like, it would be great to be able to say nobody can beat this company's technology. They have a patent on that technology going forward. It is very difficult to find at that scale. They could gain it over time. Often, a great management team can be an advantage. Do I define that as an absolute moat? It would be soft at best, right? And then obviously, it has to be a team, because if it's one person, it's a fragile moat if that person is not there with the company as well. So
one thing I'll just say about Elon Musk's comment there, it's almost like with what he's saying, he's kind of making the assumption that a moat is just something that just sits there and it gives you absolute protection, or is supposed to, and you don't ever have to do anything to defend it. But if you use the analogy of a moat around a castle, you'd think like, well, no, if your castle is being attacked, the enemy is they're finding ways to like build bridges over the moat or get over the moat, and you're needing to constantly be defending it, and pushing off their attacks, right? So it's, all I see as a moat is just, it's something there that's real, structural, maybe, that is protecting your market share. But it doesn't mean that like you don't have to continue to work on your moat, repair it, defend it, or that it gives you absolute protection, or is supposed to give you absolute protection, because moats obviously can be crossed.
Yeah, I mean, I think it's silly to think that Buffett was just saying you built that moat and then you're protected for it. I mean, you'd have to have innovation
Mhm.
going forward to protect that moat. I mean, it reminds me, I think one of the it's a horrible example of what went on in the real world, but the French after World War One built the Maginot Line, like it was a line of concentrated fortifications, obstacles, weapons built, and they spent at the time a massive amount of money doing that after World War One, and then the Germans flew over it. So that kind of ended that moat that they were trying to
Well,
build
they actually
around.
went around it as well. They
Yeah,
actually
did
just
they
went
not
through
fly over
Belgium
it
and
at
just
some
went
point
like
too?
right
Yeah.
around it because
Well,
it
you could
covered
just do.
the border between France and
Yeah,
Germany, but not Belgium. So you could just basically go to the end of the line and
but
walk around it.
going around is just ridiculous too. But there's technological innovation flying
Yeah.
over it as well too. So yeah.
Yeah.
But you've got to continue to innovate. And again, Elon is just kind of taking. I don't think anybody is thinking that Warren Buffett would say you just built that moat and then you're good. This company now you've got to continue to build on that moat over time.
And just because we're a big history podcast, I just looked on Wikipedia, so take it for what that is. But they spent around 3.9 billion in today's US dollars worth on the Maginot Line. So
Yeah.
3.9 billion. Anyways, thought I'd get that number.
Quite the spend. And then just
They
they walked
drove around
around
it.
and flew over. Basically, that's what I understand. All right, let's go on to. I think Brennan is going to look at It's a small segment on when to
Correct.
sell a stock that you did in the
In the
10x
web.
webinar.
Yeah,
Yeah.
exactly. And in that webinar, I actually go over another example there that's still in coverage. And we actually assessed that stock as a case study. But anyways, when should one take profit? And this is a question that we get all the time from clients. And as you can see, just a couple of weeks ago, I received this email from a client asking when he should take profit as he was up over 100% on one of the stocks we have under coverage. And that stock was actually Cipher Pharmaceuticals. And unfortunately, I said to this client, the answer isn't always as straightforward as most would like. It needs to be taken on a case-by-case basis for each stock which you own, and ultimately depends on the underlying financials of the business. And we went through some examples together over the phone so he could kind of understand what I was meaning. So in this section, I will touch on the issue of how to hold a great stock long term, and we'll run through a case study example from our past coverage so you can understand when you should either take some profit on a stock, hold, cut your losses, or potentially even buy more. So before we jump into the case study I have, I'm just going to quickly show the framework which we will be assessing the example on. And like I already mentioned, we need to look at the decision from the perspective of why the stock went up or down and how the business fundamentally looks today. And this includes, why did the stock go up or down, and is the move justified? Was it driven by good financial results, some kind of news, macroeconomic factors, or simply just sentiment driven? We need to look at what type of business we are dealing with. Is it a stable growth stock, contract driven, commodity based, or cyclical or defensive? Now, if the stock is contract driven, cyclical, or commodity based business trading with elevated valuation multiples, we would typically be more prone to take profit if the stock is up, given these businesses have more volatility in their financial results. And the last here, what are the valuations looking like relative to its growth outlook? Is it fair value, undervalued, or overvalued? So the case study here is on Photon Control, PHO, on the TSX. They are a manufacturer of optical sensors and systems to measure temperature and position for semiconductor manufacturers, which tends to be quite a cyclical industry. And we originally recommended the stock in 2014 at 46 cents per share because the business had strong backlog over the previous year. So we anticipated growth in the business, and it traded at just 8 times earnings. Then in fast forward to 2018, the stock traded at $2.40, up 420% since our initial recommendation. We reassessed the business and decided it was diligent to take profit given the volatility of the cyclical semiconductor sector, along with a heightened valuation at 24 times earnings. And we basically repeated this process from 2020 to 2021, re-recommending the business at 88 cents. As the business's backlog again grew substantially, indicating there was a growth path ahead of it. And based on our earnings estimate, it was trading with a forward price to earnings multiple of about 8 times. And finally, advising clients to take some profit in the $2.70 range while growth was slowing. Management noted that on the conference call, and the valuation again became elevated. And just a few weeks later, the stock was bought out at a large premium at $3.60 per share by MKS Instruments. So again, to go over our framework, the reason for the share price move was due to a surge in backlog and EPS growth. So it was certainly justified. But again, earnings are quite volatile with this cyclical contract-driven business, which made us more prone to take profit when it traded with elevated valuation multiples and when it also appeared that growth was slowing. Now, if a stock goes down, you can also do the same process, which I followed here. Look at the business from a fundamental perspective, understand what kind of business it is, why the stock has gone down, and determine whether you should cut your loss and move on to a better opportunity or if the investment thesis remains intact. Now, again, I did say this earlier, but in the webinar that we recently did, that can still be purchased on our website on demand, we go over another example from a stock that is currently under coverage. And despite that stock running over 100%, we would actually continue to buy more rather than take profit given the increase in its earnings, as well as it's a relatively stable business model and it has a reasonable valuation in relation to its growth path. Again, all despite the stock being up over 100% since our initial recommendation. So yeah, that's my segment. Again, I think that there's some good takeaways here, especially like, just looking at a business. Is it cyclical? Is it commodity based? Is it stable? Is it defensive? Even just looking at a business from that perspective can definitely help someone understand whether they should or should not take profit.
Yeah, I love that categorization of the defensive, the stable growth, the cyclical, because that really determines where a company falls in terms of those categories, determines like, well, what's reasonable debt leverage that they can carry, right? So the debt leverage for a mining company is going to be different than for a utility company, for example, right? As well, valuation, right? Growth expectations.
Yeah, no, I believe it's a good summary, and that's how we categorize when we're actively looking at whether or not we want to take a profit on a company, take half the position out, whether or not this company has that cyclicality to it, whether or not we're tracking the backlog in the business, if it's contract driven, or is this a SaaS business that we don't see much cyclicality in, or is it a recession resistant business and then it's still trading at reasonable valuations and we want to own this company long term. Those are the determining factors we make. So it is always on a case by case basis. When you're looking at, there is no one size fits all rule. All right, we're going to close off the show. Brett is going to look at what company you're looking at. Oh, you're looking at Ballard Power today, right? Yes, you are. A company that's been around for decades, always with a promising technology, very volatile share price, and not a hell of a lot of earnings.
But does Brett understand the technology?
We will see.
Yeah.
We'll look to the comments after I do this.
Yeah, that'll let us know.
All right. So like Ryan said, Ballard Power System symbol BLDP on the TSX as well as the NASDAQ under the same symbol, is a developer and manufacturer of proton exchange membrane or PEM fuel cells, a type of hydrogen fuel cell. The company is targeting the medium and heavy duty mobile market, so buses to trains, as well as stationary power applications. The stock trades at $1.70 US, down 53% year to date at a market cap of $510 million. And zooming out further, I'm not even going to go to 2000 when it had another peak there. But in 2021, it has actually fallen since that peak in 2021, over 95%, which is just not great, obviously. So what has driven this decline And does the financials and operations really give any hope for recovery to either these levels or just an improvement from this $1.70 figure where we're at now? So first, we'll look at a 10-year high-level view of the income statement. We can see stagnation in revenue really after 2017 in that $100 million range. But further, we've seen a further decline into now a gross loss. This means every unit sold produces additional losses at the current cost and price combination. Sometimes you will have a bit of economy scale within the cost of goods sold, but it's not the major factor. You might have, let's say you have a production line, a person can do one unit and then a quality control person can actually look at 100 units at a time, but they're only making 50. So you could double production and that would appear in cost of goods sold, and that'll be economies of scale with cost of goods sold. But that's not always true, and that's something you really want to watch. But it can shift over time. Further, the company has never been operationally profitable on an annual basis and is not profitable in any sense for net income either during this time period. This means over time, when you do see these consistent losses, the operations needed to be funded by first existing cash and then by raising capital through either debt or equity issuance or selling assets in some manner. Ballard has gone down the equity issuance route, having outstanding shares increased by 126% over the past decade. This is even with the company taking advantage of that euphoric share price in late 2020, early 2021. In the graph I have up, you can see that when the shares are issued, the cash balance goes up. And then, of course, it just trickles down over time because they're continuously cash flow negative again and again. And it hasn't really changed. And they really benefited from that share issuance time as well. In reality, they've been fueling themselves not really on hydrogen sales, but on share issuance. That's really been their most profitable venture at this time, which is a bit worrying to say the least. The cash balance, however, currently sits at $678 million, and that's actually higher than the company's current market cap. Whenever I see something like this, that's normally a massive red flag, because people always say, oh, why don't you just go in and buy a company? In reality, you can't do that because it would bid the share prices up. But that means at this time, the market is actually valuing the operations of the company negatively. If you could just do a one-to-one, I get all the shares at the current price, something has to negative off that cash flow. And that'll be the the cash balance, not the cash flow. So leading us to the Q2 2024 results, the last quarter, the company had a $16 million revenue, $60 million in revenue, a negative gross margin of 32%, and a net loss of $31.5 million or 11 cents per share. The company's 12-month backlog fell quarter over quarter to $169.5 million. Also, I will note, if you look at their previous backlog, and they provide a 12-month backlog, is the actual revenue, if you look at the realized revenue, was only about 71% of their initial backlog of Q2 2023. So you only have a backlog to revenue conversion rate of 71%. So this is something I've brought up before, and I know the rest of the guys on the podcast have as well, is when you're evaluating a backlog, are they actually converting? And in this case, they're not converting one-to-one, which isn't uncommon. But that is something you need to be aware of if you're looking at this and saying, oh, they're actually looking at growth now. It's really actually quite a similar backlog to what they were expecting in the last year. The company does provide expense guidance, not revenue or profit guidance, but they have updated the total operating expenses of the company to be $145 million to $165 million. And then a change in the CapEx expenditure, I should say the total operating expenses is the same as what they had at the start of the year, but a lower CapEx expectation of $25 to $40 million. So last week, September 12th, the company announced a restructuring of the business. The CFO and the CEO have been replaced, or are going to be replaced by the end of 2024. A plan to reduce total operating expenses by 30% in 2025, with the reason being to align with the delay in market adoption of hydrogen infrastructure, hydrogen fuel cells, and so on. As a part of this plan, the company is as well conducting a strategic review of its Chinese joint venture, Weiche Ballard, which it has a 49% stake, and that's common for Chinese ventures. It'll be the local company being 51%, and then the foreign entity, in this case Ballard, being a 49% stake or something like that, due to Chinese regulations. But they might leave that, they might change it. That's what a strategic review will be doing it during this time. Effectively, the goal really is to extend out the company's cash, hoping for hydrogen infrastructure and fuel cell technology and demand to increase. But that is really speculative at this time if it is going to increase. Fuel cells, especially hydrogen fuel cells, has been just something that's been going on for decades at this point. If you've looked at the company's history, like I said, it was surging in 2000 as well, not just a few years ago. So really put together, the company's operations just have not been, and in the current state of hydrogen infrastructure and fuel cell market, are just not financially viable. The company does have the ability to lean on its cash balance at the current burn rate for 4 to 5 years, and maybe a bit longer if they're able to temper losses in the coming years with post-structuring or restructuring. But that really brings me back to why they have the cash in the first place. It wasn't due to profitability or successful ventures. They didn't sell off something successful and just were left with the scraps. It was because they were share issuing. They had significant share issuance and really were lucky. That's what comes down to some of these companies is the market was euphoric at the time. They were in 2000 as well, leading to these massive cash balances, which unprofitable companies can lean on for a time being. And that was really just absurd valuations and unrealistic expectations for, this is across really the hydrogen market, hydrogen fuel cell market as well, not just Ballard. So sure, there's a chance that there could be a turnaround in 10 years, given this cash balance. They do have some runway, that which is better off than companies which are already in a net debt position, already needing to dilute quite a bit more than 126%. But that's not really something I would want to count on. That's really just being hopeful at best. It's a gamble on the hydrogen fuel cell market really improving, demand increasing, and then being able to eventually shift into profitability. And when you're looking at a company with effectively at this point a 30-year history and it's not profitable, that is just concerning in its own. Even if they do restructure, that's not something I would be willing to bet on, and that's not something I would want to invest in either. So I'd just stay away, as it's not operationally successful, and it really doesn't have a strong path or even a forward to pathway to get to the operational success it would need to even support its current valuation, excluding the cash.
That's good.
I think you're right, definitely. I mean, this company was lucky as all hell that they raised capital.
They've been
when they
around
did.
for a long time, and if they haven't
Oh,
figured
yeah.
it out, I mean, they're still losing a couple $100 million a year, almost double the level of revenue. I mean, if they haven't figured it out by now, this has been decades they've been at it. So
Yeah, they raised the amount of capital that they did, and then you just have that cushion. And again, there's a culture in this business of not having to produce any profitability. I mean, they've had the next great technology for a couple decades. It also shows you how long it takes to bring a new technology forward. And as far as an investment, I mean, it's a poor investment if they can never, over a 20, 30-year period, produce anything close to profitability. And it's just not there for this business.
Like,
perhaps at some point, but you invest based on hope and a dream, which is what this business is, with a poor culture in terms of creating profitability. And this is what you get.
yeah, I kind of like got into it with my cousin like a few weeks ago, or maybe months ago, because he has in his head that he thinks that there's no doubt that hydrogen fuel cells are the future. And it's just like, haven't we already seen the market decide that that isn't the way that we're going? Again, I'm not saying that these applications can't be
but
used.
your cousin's smarter than the market, though.
And he understands the
but
technology.
maybe the future
Because
will
we don't
be.
understand the technology.
No.
He understands the technology.
And maybe it will be, but again,
Maybe the
That's why
future
he's
will
a
be hydrogen.
multi-billionaire,
Does that
and
mean
we're not multi-billionaires, Brennan?
does that mean Ballard is the one that's going to be successful too? Like, that's what, even if you are right, that, even if he is right, does that mean Ballard is going to be the company? So you have multiple layers of risk before you get to. And again, this is what we talked about at our webinars. Everybody's buying a company like Ballard because they want to make 10x, 1,000%. They want to make, because it's high risk and they want to make that return. The data tells you that 90% of the companies that actually went up 10x over the past decade basically were profitable before they started going up. So look for those companies if you want to have even a chance. Profitable, smaller, and growing. Don't look at the unprofitable businesses out there. It's just not where you're going to find the returns you're looking for. Not me telling you. That's the data telling you that. So anyways, we'll say that over and over again on this podcast.
Yeah, people have heard it.
You think?
Yeah.
I know. What were you going to say? Sorry, anything?
I was just going to say the caveat is unless you understand the technology. I'm joking.
Well, and that's like Ryan said, is even if we did understand the technology is, it might work, but is it even financially can you even profit off of it after the technology even works? That's the funny thing, is when you have those technology gurus, yes, the technology may be fabulous, may be the best, it may be the improved version, but if it costs too much and doesn't actually meet the financial obligations of a shareholder, it's still not a good investment. So there's even another hurdle.
There's many examples of that, even the best technology not even winning out. Like if you go back to like tape cassettes, there was beta and VHS. I don't know if Aaron remembers this, but it was proven out that beta was probably the more advanced, successful technology to use. That VHS won out for one reason that I don't even know if I want to mention, but the porn industry basically went with VHS, and that's everybody went on to that, and that was it. Apparently, this is what happened. So, Aaron knows all about that. What am I saying? Sorry.
Sounds like you know all about
one of
it.
the reasons that VHS won. No, yes. I still have my beta. I wouldn't even go DVD.
Yeah, you wouldn't. You still like beta. Just like vinyl, the beta picture is so much better, right? That's what you think. The sound on vinyl is better. Aaron's beta sounds better. It's not really. All right. That's going to end our episode for this week. I'd like you to keep your questions coming into our Your Stock, Our Take segments. We'll endeavor to ask those on a weekly basis. If you're watching this right now on YouTube, smash that subscribe button. We can keep providing this content to you on a weekly basis. If you're listening to this, wherever you consume your podcasts, rate and review us on there. And as always, I'd like to wish you profitable investing. Thank you.
Thank you, everyone.
Thanks, everyone.
Thank you.